All right, let's dive in. Forever, real estate has been seen as the way to build wealth. But the game has totally changed. So today, we're going to break down how you can actually invest in property right now in this modern age. And it all starts with this one powerful idea that has driven people for generations.
You've probably heard this quote from Andrew Carnegie, right? It's been around for over a century, and it has absolutely fueled the dream. This idea that owning a piece of property is the surest way to get rich. Well, it's baked into our culture. It just feels so solid, so stable, a real, tangible thing you can actually see and touch.
But here's the thing. There's always a catch, isn't there? We've all heard the landlord horror stories. You know, the phone call at 2 in the morning because a pipe burst, the arguments with tenants, the never-ending repairs. That hands-on reality, it's a huge barrier for most of us who just want the financial upside without basically getting a second job. But what if you could have it both ways? What if technology finally figured out how to give you all the benefits of real estate without any of the traditional headaches? Well, spoiler alert, it has. Let's take a look at the modern solution that's making this possible: fractional real estate investing.
The whole concept is actually pretty simple. Instead of needing, hundreds of thousands of dollars for a down payment on a single house, you can buy a tiny piece of it, a share. And just like that, the two biggest walls to entry, the huge upfront cost and the hassle of being a landlord, they just crumble. And of course, a whole industry has popped up around this idea. You've got platforms like Lofty, Fundrise, and Arrived Homes, and they have completely changed the game. I mean, just look at those minimum investment amounts. You can literally start building a property portfolio for less than what you'd spend on a night out. It's incredible. So what's really cool here is seeing how these different platforms are designed for different kinds of people. You have Lofty, which is all about flexibility. You get daily rental income, and there's a marketplace where you can sell your shares. Then you have Fundrise and Arrived Homes, which are more for that long-term, set-it-and-forget-it growth with quarterly payouts. So yeah, it's definitely not a one-size-fits-all situation.
So the dream is definitely alive and well. The promise here is huge. You get all the benefits of owning real estate, but it's simple, it's accessible, and you can do it all from your phone. It sounds perfect, maybe a little too perfect. And that brings us to our next point.
Because here's the hard truth. Even though these platforms take the landlord duties off your plate, this idea that any real estate investment is completely passive, well, it's a dangerous myth. It's a fantasy that's pushed all over social media. So it's time for a little reality check. Let's just pause on this for a second because this is so important. The myth of passive income is that you do absolutely nothing and money just magically shows up in your bank account. The reality? Real estate investing, no matter how you do it, always takes work. Think about it. Finding tenants, screening them, handling repairs, dealing with the finances, all of this is the invisible work that comes with owning property. And here's the key. Even if you're not the one doing it, someone is, and that someone has to get paid. This unseen work is always happening, and it always has a cost.
And this chart shows you exactly where that money goes. Before you see a single dollar of profit, that rental income has to pay for the mortgage, the taxes, the insurance. You've got to plan for times when the property is empty. And look at that slice right there, property management fees. They usually take a flat 10% of the rent, right off the top. All of a sudden, that cash flow you were dreaming of looks a lot smaller.
And that's not even getting into the really big risks. Real estate markets go down just as easily as they go up. Rising interest rates can completely wipe out your profits. And legal liability, that's a huge one. A simple slip and fall accident on a property you own, a piece of, could lead to a lawsuit that costs tens of thousands of dollars. Passive definitely doesn't mean risk-free. Okay, so we've looked at the dream and we've faced the reality. But the point isn't to get scared and run away. The point is to get smart. To be a successful investor, you have to understand where you fit on the spectrum of involvement. So let's break down the main strategies from the most hands-off to the most hands-on. So on the far end of the hands-off spectrum, you've got something called a triple net lease, or NNN. You see this a lot in commercial real estate. Basically, the tenant, often a big company like a Walgreens or a Starbucks, pays for everything: the taxes, the insurance, and all the maintenance. Your only job is to cash the rent check. It's so reliable, they call it bonds tied to a rock. Next up, you've got investing through funds. On one side, there are publicly traded REITs, that's real estate investment trusts. They're super easy to buy and sell, just like a stock. But the downside is they often move up and down with the rest of the stock market, which kind of defeats the purpose of diversifying. On the other side, you have private funds, where you have a clearer idea of the specific properties you're investing in, but the trade-off is your money is often locked up for years. It's not very liquid. Okay, now we're starting to get more hands-on. This is the classic strategy. You buy a property and you become the landlord. The upside, you're in complete control and you get to keep all the profits. The downside, you also take on all the risks and all the responsibilities we talked about in that unseen work slide. It's all on you. And finally, at the most active, most hands-on end of the spectrum, we have the BRRRR method. This is a really powerful strategy, but it is intense. So you buy a fixer-upper, you rehabilitate it to force appreciation, you rent it out to get cash flow, then you refinance to pull your initial investment back out, and then you repeat the whole process with another property. It's pretty much a full-time job, but the potential to build wealth is just massive. So we have covered a ton of ground here. Everything from a $10 investment in a REIT to the full-on intense BRRRR method. But here's the most important thing to remember. There is no single best way to invest. The right path for you depends completely on your own goals and your own life. You have to ask yourself these 4 questions. Seriously, how much money do you have? How much time can you commit? When do you need to get your money back? And how much risk can you stomach? Your answers are going to point you to the right strategy on that spectrum. If you have very little cash and no time, maybe those fractional platforms are for you. If you have a background in construction and a high tolerance for risk, maybe BRRRR is your game. Just be honest with yourself. And one last thing, no matter how you choose to invest, you absolutely have to understand something called the capital stack. It sounds complicated, but it's just a fancy term for who gets paid first if things go well or go wrong. The debt investors are first in line, so they have the lowest risk, but also the lowest return. The common equity investors, well, they're last in line. That means they have the highest risk, but if the deal is a home run, they also have the highest potential reward. So before you ever put a dollar in, you need to ask, where am I in the pecking order?
At the end of the day, the new rules of real estate are all about having choices. You don't have to be a millionaire to get started anymore, and you don't have to become a full-time landlord. The opportunities are out there across the entire spectrum. So the real question is, when you think about your money, your time, and your appetite for risk, what kind of investor will you choose to be?